Welcome to Top M&A Entrepreneurs. Today, my guest is Kevin McGee. Kevin McGee is an attorney who actually bought a company about 5 years ago, a craft brewing company, put it into a QSBS, and then just recently sold it. Somewhere around, right around the same time, the Big Beautiful Bill came out and put some major changes. The QSBS, which was Qualified Small Business Stock Program, which is kind of sounds amazing, like you're going to keep a ton of capital, ton of profits and not have to pay capital gains tax. But there's some nuances with this, Kevin. So why don't you kind of walk us through the mechanics of your QSBS play, um, and talk about a little bit how that happened and what that looks like for you? And like, should everybody do it? Should everybody be jumping in and changing a LLC to a C corp?
Well, short answer, no. So, um, it's something that takes some consideration. It's probably most effective, really at the evaluation acquisition stage. So, little kind of primer on what qualified small business stock is. So, there's a statute in the Internal Revenue Code, it's 1202, that basically says that if you hold stock in C Corp, that's one of the qualifications, for a certain period of time, and it meets these certain qualifications, then your capital gains tax on that investment is basically excluded. It's forgiven. So if you get, if you are using, which is what we did, we took $10 million of capital gains. All of it was capital gains from another investment. We rolled it into a C Corp, and that C Corp, because it ended up qualifying under 1202, got 100% of its capital gains excluded, which means that we paid no capital gains tax on $10 million of initial funding, which was, an impact of over $3 million that we literally just got to keep instead of paying it, instead of it evaporating into the government somewhere. So it can be a really, really powerful thing. Um, there are, some nuances to it, making sure that you check all the boxes. It'd be a terrible thing to kind of miss one of the qualifications and think that you have this investment that you are going to get, exclusion of capital gains tax on, and then find out after the fact that it didn't work. So there's a few things to kind of take a look at, particularly for people like search funders and entrepreneurship through acquisition folks. To flag when they should really be paying attention to this and seeing if they can take advantage of it. And at that point, go get a tax professional or attorney to kind of dial it in and make sure you get it done. But really, that the basic, premise of it is that there's a list of stuff in section 1202. If you get stock, it's got to be an original issuance from a C corporation. The company's got to be engaged in active, participation in some specific areas. Like you can't, invest in, service, like some things like legal or accounting firms and things like that. But there's a whole
Yeah,
list
that
of
sucks.
stuff.
I was looking at that. That
And
was
there's some limits, like, it's supposed to be small. So the recent bill just changed the limits from 50 million to 75 million. So the company has to be under $75 million now, $50 million before the bill, in terms of the gross assets on their balance sheet, including the stock that comes in, and a few other things. But it's kind of there. If it meets those standards, then it makes sense to really kind of engage somebody, take a closer look at how you make sure you dial it in, because it's literally 100% avoidance of capital gains tax. And there's a few other changes that the bill did, that we can talk about too. But that's basically what's going on with qualified small business stock. And it's fun. I should also point out that I'm a lawyer, but I'm not any of y'all's lawyers. So this isn't legal advice,
it's
directed
just
towards
how it's
anybody.
done, right?
Hire
Yeah.
your own lawyer or come and hire me. We can work it out, another way, but don't rely on this as legal advice. Go get some professional advice directly for your situation. So
Curious, is it the pro business attitude for the changes, or what's the there's always, when you look at something like, okay, why did they do this? 50% after 3 years, 75% after 4 years, moving from 50 to 75 million, and raised the basis from 10 to 15.
10 to 15.
Why did they do that? Is this just a pro business,
Yeah, the program's
administration?
always
Yeah.
yeah, the program's always been pro business, and it's been a bipartisan pro business thing. I mean, some of the stuff, the 100%, the change from I think it was 75 to 100, and there's been other pieces of legislation that has ramped up the efficacy of QSB, investments, and they've been through, I mean, there's no specific political bent. It's just the idea that we want investment in small business that's happened. So probably some of the biggest changes happened, I think, 7 years ago. Maybe 7 years ago, 8 years ago. I don't know. I think it was the Obama administration actually that really kind of put some efficacy into it and some of the restrictions. But it is, I mean, it is definitely a pro-business thing. It's similar to the investment zones concept that,
Opportunity zone kind of things.
yeah, the
Yeah.
opportunity zone. Sorry,
Yeah.
that got some kind of fuel into it, also. But I mean, the recent changes with the bill is that it changed the amount from 10 million to 15 million dollars of capital gains that can then be the basis for the exclusion. It then phased in some exclusion. It used to be that you had to hold the stock for a 5-year period. There's another section, 1045, that allows you to tack on investments. So if you have to exit an investment early, it gives you a period of time to reinvest it in more QSB stock. We actually did that in our investment. And the other aspects of it is that it phases in some of this stuff. So when you hold it for 3 years, 4 years, 5 years, I forget the specific years in the current statute, but it used to be 5 years or nothing. Now there's a stepped up level of it, so you don't need to hold on to it for
Yeah. And
so
why do
long.
you think they do that? Because people have different exit times,
Yeah, I think
needs.
it
Yeah.
was just draconian. It's all or nothing is never really a great way of kind of monitoring and managing people's behaviors. If you're trying to manage and you're trying to encourage this kind of behavior, being able to phase it in and increase the incentive for the longer hold period makes sense. But the the difficulty with having a 5 years or nothing period is that if people are doing a risk assessment, am I going to hold this stock for 5 years? Can I afford to hold this stock for 5 years? Um, they may not just, try it. I mean, there was a threshold determination you had to basically commit towards an illiquidity at 5 years, that now you don't have to.
So let's take a scenario. Somebody is a searcher. They want to buy a business. It's an SMB, and it's or an LLC, and they're purchasing. Most of these things are purchased with as an asset purchase, right? And they come to you and go, "I want to take advantage of this and not pay any capital gains tax in year 5." And you tell them what happens. What's the next step in the roadmap here?
So we worked out a way, and it wasn't anything that I did that was special. I figured out what other people who were smarter than me did before me, and
Sure.
we just did it.
That's how we all.
Um,
Yeah.
so what you can do, if you want to acquire something through an asset purchase transaction, is you form your own C corporation as the acquisition corp. So the investor capitalizes the C corporation and then receives stock.
But
That
being the
C,
same person, he could be the same person, right?
yeah, it can be a
Yeah.
single member C corporation. That's what
Yeah.
we did. So you form a C corporation. That C corporation gets capitalized in return for stock. Now that C corporation has to act within the definitions of 1202 to be a qualified small business. Now, one of the things that is important to recognize is that the 1202 requirements also include a certain period of time where you can use capital to go out and do research and development and then go and develop what is your qualified business activity. So
Is
you
that the
have a
difference
period
from
of
the
like,
R&D tax breaks that you can get?
that's
If
different. It's
that's different, yeah.
it's a period. Basically, what it is that the statute says that, a C corporation has a period of time after it issues the stock to use the capital that it has to go and develop a line of business that qualifies under the statute. So you have basically about a 2-year period of time where you can take, a C corporation and be like, C corporation search fund co, capitalize it with now, $15 million, issue that stock back to the investor, and then that C corp then has about 2 years or so to be able to figure out and find a basket of assets to go acquire and then operate as a business.
And those
And
could
then
be other purchases, acquisitions.
right. So
Yeah.
we'll get back to what we did. So what we did is we took $10 million that was basically 100% basis of capital gains. So we took that 10 million, put it into a C corporation, formed a C corporation, and then that C corporation issued stock to the original investor. So that right there is actually the QSB investment. So then that company that we capitalized went out and bought the assets of a craft brewery. And then we went and operated the craft brewery for a little over 5 years, sold the craft brewery, and then at that point we can end up liquidating the assets that we got in return for selling the craft brewery, then distributing them back, basically dissolving the C corporation, and then the investor basically gets their money back. And in the meantime, what ends up happening there is that you have an investor that gets an issuance of qualified small business stock from a C corporation. That C corporation goes and does an asset purchase, operates and runs that business, and then can sell that as another asset sale. And none of that affects the fact that the original investor still has qualified small business stock in the C corporation. So that's how we got around the idea of entering into asset purchase and sale transactions while still maintaining the benefit of the qualified small business treatment.
Yeah, and you're an attorney and not a tax advice. So how do you stay within those guardrails and not go out? I mean, was there any time that you go like, okay, we got to check, we want to go buy some assets, cash flowing assets, got to make sure it's under, at your time it was 50 million.
Right. Now
Uh,
it's 75.
Now it's 75. How do you know that you got to stay in those guidelines and you keep growing and go, well, look, I got a company. It's a rollover. It's doing, friend of mine, Brian Beers owns 35 Midas franchises, right? He's doing
Uh-huh.
50 million. He's really close. To a couple of years, he'll be past that, at 35 million. So, or 75 million. So how do you stay in those guardrails?
You talking about the cap, the
Yeah, well, they're
50
not
now
the cap, but
75 cap?
everything you're doing as far as asset purchase grant, right? Or let me ask you a different way. If I'm a $85 million company now, can I still be at 75? Do I have to stay below the 75 million cap?
It has to be 75 at the time of the stock issuance. So here's the stock, for the stock to qualify, it has to come from a C corp and it has to be an original issuance from the company. So there's ways to transfer QSB after it's been issued, but the actual shares themselves have to be original issuance. You can't go buy them in the market or do something else. So they have to come from the company. Now it only has to meet the total asset value on the balance sheet at the time of issuance.
In your form in
So
the QSBS.
so
Yeah.
for
Yeah.
us, it was 50 million. So if, the assets that, if basically the balance sheet had assets of 49 million, when with the issuance of the stock, and then a few years later, it, went over 50, that's still fine because at the time you invested, it was still considered. And that's done to try and make the investments meet the characteristic of being a small business. So if at the time you invested, they're under this threshold, then that still qualifies as a small business. Now, if it grows from there, and ideally it does, that's fine. But when the stock is issued is when it's measured. Now, the important thing is that the assets on the balance sheet include the capital from the issuance of the QSB at the time. So if I'm looking at a balance sheet that's at 49 million in the or now 74 million now, and then I put in, I buy $3 million worth of stock. Well, that just pushes us over the 75, and so that won't qualify.
Yeah. And
So
how
it
would you
has to
fix that?
include the
Right.
capitalization. So you obviously you figure that out, beforehand, and you determine, if you're looking at a company that, you're looking to invest in, and the balance sheet assets are right around the line,
Got divest
that can be a
somehow, right?
problem.
Yeah.
So
Yeah. Well, there's a couple questions in the search funder about talking about the nuanced difference between uh, the assets. Do you remember those comments where he was talking about?
some I jump in and out to Search Funder. It's kind of funny because I like Search Funder. I found years ago, like in like 2018,
5
I
years
think.
ago, you posted you purchased a craft brewing company, which
Yeah,
is
well,
pretty
I mean,
cool.
I didn't realize it, but I kind of stumbled into being a search funder without realizing it was a thing at the time. So we ended up capitalizing this C corp, and then going out and looking for businesses, and all of a sudden I'm doing some research and looking around, and someone said, "Hey, go check out the search funder stuff." And so I found Luke and the search funder website. I'm like, "Oh, geez, this is exactly what we're doing."
Yeah.
So I kind of I backed into it, not realizing that there's a whole community that they had a pretty developed sense of identity, around all this stuff, and just kind of fell into it, which is cool.
Let me ask you about. I think the nuance was about targeting 3 to 5x multiple businesses. How do you model out the benefit of QSBS, zero cap gains tax, versus a real world valuation where C corps may get a haircut because you're buying all the liabilities, maybe any
Mhm.
legal problems, any IRS problems, whatever. When you're doing your UCC
Yeah,
filings, you find anything,
I,
open the
I
closet.
would model it out by zeroing it, and I would just do what we did, which is we form your own C corp, capitalize that, and get the QSB stock, and then buy the assets.
Say that
Um,
one more time because, like, I think that's like, yeah,
yeah, so I basically I wouldn't do a stock transaction if I could help it.
yeah,
And you can help it. So, in order to do this, what you do is kind of what I described earlier, which is what we did in our transaction, which is we form our own search funder C corp, capitalize that, and then use the cash that that corporation has from issuing the stock to us, to the investor, to go and buy the assets. So I would avoid the stock valuation issue altogether, because you don't need to. And I mean, I've been an attorney for a while. I'm counting up, kind of doing the rough math. I've been involved in, I think it's over $2.5 billion worth of transactions, and only a real small fragment of those were stock transactions.
yeah,
Generally,
very small.
everyone
Yeah,
generally wants to do asset transactions anyway. So the way you do that is what like I just said, it's like you form your own C corp. You have the investors have the relationship with the C corp, and then the C corp just goes buys assets like anything else.
yeah. How early in the process should you form a C corp to qualify for it? And is it a difficult?
Um,
Is it a difficult presentation to investors saying, "Hey, we're going to do QSBS on this deal," and just you hang with this for 5, 4, used to be 5, now it's 3, 4, 5 years. Capital gains. What kind of investor is that?
um, I I think there's actually a lot more recognition and sophistication of investors around this kind of thing, particularly angels and other folks that are deploying, couple hundred to a couple $1 million, couple 100,000 to a couple $1 million. The venture funds absolutely understand QSB. Um, but I think there's more awareness of it now, and so if you come at them saying, "Look, we're going to do this deal. It's an asset purchase, but the vehicle that we're going to use to acquire the assets is going to be a C corp because we can realize a qualified small business capital gains exclusion on that basis." Resonates with people. And again, if you're going to put together a pitch deck and start, doing some fundraising and things like that, it makes sense to run the structure by, a tax or legal professional, and make sure that you've got all that kind of dialed in, and have them take a look at your slides in your deck talking about, the possible harvest of the capital gains exclusion. And the other thing that to kind of recognize is that 1202 QSB capital gains exclusions are not limited to individuals. It can be an LLC, it can be an S corp, it can be a partnership, it can be anything else, is capable of holding qualified small business stock. So if you have an investment entity that's like an LLC, or you got running a GPLP, fund structure, the general partner can hold stock that qualifies under 1202 QSB and realize that exclusion. And then that, not to get too far, aside from this, but this was something I was thinking about a few years ago. I ran a small private equity firm for a little while, and it got me thinking. It's like you can actually go out and capitalize and fund a general partner PE fund, with capital gains and from other investments, and then figure out ways to deploy that in different QSB qualified, business categories, and basically, end up getting, capital gains exclusion and guaranteeing people, that, the exclusion as a return over and atop of, the original investment.
Yeah. So you're
So,
saying that, let's say normally your tax accountant, you're going to be paying $3 million in capital gains tax, but you're not now. So, yeah. And can you keep rolling it over into a new QSBS structure? Like until you avoid ever, or what? I mean,
well, you can hold the stock as long as you want. Um, it's an exclusion. So, I mean, if you, you don't, it doesn't, you don't get more. And, it's capped at, 15 million in
yeah,
basis.
yeah,
So, I mean, that would be like if you're starting with, just sort of basically straight money, and then you end up, making a killing on it. And, you end up, you're going to realize when you sell the stock, you're going to realize, 10, $15 million worth of capital gains. Then, that would be your timeline for it. Once you get, I mean, if you've held it for, 5 years, and you've got, you know, 17 million of capital gains, you're not going to get anything more from it from a capital gain structure. But in that case, it's a really good investment. So you might as well,
yeah.
stay in it.
So where are the landmines with this thing? I mean, have you?
Compliance.
Yeah. Well,
Yeah.
what's that? I
Yeah.
mean,
It's
it,
that the compliance is just making sure that the stock that the investor is receiving, again, investor can be an individual, can be an entity, is receiving, qualifies under the statute. So you want to take a close look at the statute. It's got some limitations for things like redemption schedules to make sure there's no churning. There's a very specific list of lines of businesses that qualify and don't. Generally, it's like every business qualified except this category. So,
accounting firms,
right,
attorneys
accounting
firms.
firms,
Yeah,
legal
yeah,
firms, that kind of stuff. So
yeah.
you want to look at that pretty closely, and then just go over it and get an opinion from an attorney or tax professional, because that in small measure, I mean, their insurance becomes your insurance if they get it wrong. And kind of do that. But really, I mean, the landmines are really, and just, I mean, the biggest ones, the draconian ones, are if you invest in something and then all of a sudden it turns out it didn't actually qualify under these very specific categories in the statute, then the whole thing is gone. Uh,
Yeah.
so that's an
Is there any
issue.
kind of insurance you can purchase for that to cover that?
Lloyd's will insure anything. It's just expensive.
Yeah.
No, I
They'll
mean
write
the
they'll
insurance.
write for anything, right? Yeah.
Yeah, totally. I mean the
Okay.
insurance is to get a
Stay in
qualified
compliance.
legal
Yeah.
tax professional that's got errors and omissions insurance to give you an opinion on it, so that you have someone to complain to if they get it wrong. So
And what
so
is that?
don't.
What
I
what
mean, and as as a lawyer, don't rely on your own impression with something like this, especially if it's going to be something where you're deploying millions of dollars. um, Go and find somebody to work through it with you, and and do that kind of thing. It's just, I mean, as far as risk aversion, goes, it makes sense, and it's a better practice for you and for any investors or LPs or anything like that anybody might be working with. Make sure you run it through there, but it's really easy. I mean, that said, it's really easy to take a look at the statute. It's written in plain English, basically, and find what all the categories are. And then when you look at those categories, that will give you an indication of whether or not this is something that you should look into further. And so absolutely do the screening, but then if you're going to go forward with something like that, make sure you get professional help so that you don't end up 5 years down the road with a, multi-million dollar tax bill you didn't expect.
Yeah, let me ask you about those gotchas. Is it like having somebody board minutes, proper valuation year to year, having somebody there all the time to make sure you're in compliance, to make sure that you don't, hey, we're going fine 4 years down the road, 5 years, let's have an exit, and oh, wait a minute, we're not in compliance, like, and there's nothing you can do to go backwards to fix it. Yeah.
Think there's definitely a measure of monitoring that should be done, because if the business practices of the business that is the stock issuer drifts from what the original qualifying line of business is, then that can end up excluding it. So if a business, you issue the stock, your search fund or co, goes, your C corp goes and buys a bunch of assets, starts operating the business, and then year two, year three, all of a sudden it starts moving into doing some sort of real estate investment activity, or something else that's excluded in the list, that can be reviewed, on the back end, and said, no, you're not using, I think it's the threshold is 80% of the assets of the business need to be, used substantially to further this particular line of business. And then there's a specific, I think it's like 10% of, capital, or 10% of the assets is a limit on what the business can have invested in, like other stocks, or other vehicles, or things like that. So if you cross those thresholds, then retrospectively you can get someone could take a look at it and retrospectively say, no, you stopped qualifying before this period of time, and therefore you've got a problem. So that kind of level would be there, but it's not like an auditing level type of thing. It's not something where you need to produce audited financials for this purpose. You don't, really need to do, frankly, that much. I mean, you really want to do on the front end the analysis and get the opinions that let you know that you do qualify for this treatment, and then plan for it when you end up harvesting it. Um, but for the most part, really the compliance would be making sure that you have, your executive team or your operators cognizant of what these guardrails are, and making sure that, they don't, start moving that way. Usually it's probably going to be something that is not going to be an accidental step over the line. I mean, the only way that that could happen, I think, would be if, all of a sudden, like, just a ton of asset value was to evaporate, and then, the percentage of what the company holds in, outside investments or publicly traded stock or something like that crosses the threshold. But if that happens, you got bigger problems anyway. Uh, but for the most part, it's like you really want to do the front end work, figuring out if this is something that's going to qualify, and then kind of understand, what that means. And after that, compliance is, I wouldn't say minimal, but it would be difficult to accidentally, um, kind of, wind your way out of that. It would be something like, just a very substantial change in strategic direction into, an excluded line of business, or, a massive, shift in the balance sheet that changes the calculation of allocation of assets or something like that. And it's not a there's very little that could really kind of manifest as a gotcha that I can think of right now. I mean, as an attorney, your job is to go and find those, so you'll always be able to find one. But how it's like the difference between statistical possibility and probability of things happening. Probability is going to be hard to do by accident. Statistical possibility, there's always statistical possibility.
Yeah. What about if you look at NASDAQ, there's a ton of smaller companies under 50. Does it matter whether public or private company?
It has to be an original issuance.
Original issuance. Okay.
So
You
it's got to
can't go.
come.
Yeah.
Right. So if you're just buying stock, through the market or something like that, it does not qualify. So it's not. And you think about it thematically. It's intended that all this stuff is intended to encourage people that are frankly in sort of the angel tier, individual investments, small, mid-market, small business sort of investment, in investing directly in small businesses that then, grow to be, to the level where they can, afford to burn $1 million a year in compliance and go public. Um, so it's generally not, going to be there. And that's the reason why the original issuance requirement is in there, is because they don't want to, all of a sudden give, kind of a free pass to 100% exclusion on capital gains to people that are,
Yeah.
just
So
rolling through
that's the
E-Trade.
segues into the playground. Like, is it? Not $5 million business and below, 5 million into 25. What's the right playground for this?
Well, revenue's not relevant to the determination. The relevant determination is gross assets on the balance sheet. And $75 million of gross assets on the balance sheet is a lot of gross assets on the balance sheet. So you can
Yeah.
have, asset-light businesses. If you have a business, I have a client right now that does a couple hundred million in sales, that owns no manufacturing. They basically co-pack everything. Their balance sheet is super, super light. So they're doing, 300, 400 million in sales a year, but still would qualify under the cap for the balance sheet. So, they may not, I haven't done the analysis, they may not qualify for other reasons, but you can have really large businesses and you can have very successful, like, highly, vibrantly cash flowing businesses that just, have a certain level of assets that are lower than the threshold that still will qualify.
Yeah.
So,
Is there any savvy entrepreneur that came to you, or you came to said, "Hey, you should go QSBS"? Savvy entrepreneur came to you and said, "No, I don't want to do it for these reasons."
no, I haven't heard. If you have an investment that qualifies for treatment under, like, basically, if there's a line of business that is an acquisition target that would qualify for QSBS, treatment under 1202. As I mentioned before, it's not that difficult to create, an acquisition vehicle as a C corp to issue the stock. So you still have the asset transaction thing. If if it's a line of business that is not excluded under the statute, I really don't see a reason not to run up a scenario and figure out how to make this work. And there may be reasons why it might not work. That could be, situational or whatever. But given that, if things work, or more relevant, if you're working already with QSBS qualified capital gains or something like that, where you're just trying to finish out, what the capital gains treatment of this particular bucket of money is. And I don't really see a reason not to do it.
Wow. Is there any question? I am not, I mean, I'm just getting really educated on this and I love to have you on. Is there anything I'm not asking that somebody else on the other side goes, should be fully aware of? Like, this is a pretty big change. And then what was that vehicle a couple years ago everybody jumped into that they're kind of a reverse merger that all the billionaires jumped into and they
Oh,
got it raised? Yeah.
do you mean SPACs?
SPACs. Yeah. They
Oh,
jumped into
yeah.
SPACs but those SPACs idea has been around for a long time. And all of a sudden goes, hey, here's a shortcut to money. It didn't work. A lot of them didn't work out. Now they're backing out. Is there anything like this? This has been around for a while. Is
Yeah,
it
no,
going to see a big rush into it again? And then all of a sudden goes, it's not what it seems to be, back out. Kind of trending
yeah,
history repeats itself.
I think it'd be well, I think it'd be significantly different. I mean, the QSB structure has been around for a long time, and what's changed with the recent statutes is not the actual structure of the program. What's changed is just some of the metrics that affect, the size of the business that can be invested in, the amount of money that can be, treated according to 1202. And then, it just, put in a stepped tier for, exclusion, where before it was, kind of all or nothing. So it's not like there's a change in, the regulations or anything else. I mean, the definition of what qualifies and what doesn't has stayed the same. I would say there's very little guidance from Treasury or the IRS on this kind of stuff. It just doesn't kind of come up very often. So there isn't a real deeply developed, body of law or guidance through, regulations on it. But
So
that said,
finding an expert aside from you in the
well, I mean,
tax
it's
or like be
no, there's plenty of folks out there that read it. It's just that it doesn't come up in controversy that much, and it may be that it doesn't really kind of come up in controversy that much because, frankly, as far as tax stuff go, this one's kind of clear.
You don't think there'll be people testing it, the
Oh yeah,
edges? Yeah.
oh sure there are, but it's not. There isn't a lot of kind of gray area on a lot of these factors. I mean, I think that the closest is there's one case where some people took a business and I mean, reading between the lines, they just kind of clearly were just trying to park their money for a while,
Yes.
and it didn't work. I mean, there's this period of time that you're allowed for kind of R&D or to develop and use the money, and it's like 2 years. So, and the case kind of pushed back on the way that they ended up doing it. They rolled, one investment into, another investment using the tacking statute 1045, and then just decided to not do anything. They just like let it sit there, and they didn't take any action to even pretend that they were trying to find an investment. And so the court came back and said, yeah, the IRS is right. You guys were just playing this.
Just yeah,
You
I'm
weren't
gaming the
actually
system. Yeah,
right.
that
You weren't
always happens, man. I just
right.
started
So
watching that show Billions with Bobby Axelrod. Those hedge
uh,
funds will do anything to like, you know,
yeah,
but this is not
yeah.
the
So
same playground, right?
we'll find the thing. Yeah, I mean, SPACs are different. I mean, SPAC is, it's a mechanism that was created to kind of facilitate people becoming public, without going through a more rigorous launch and other things. And I think from what I've seen, my view, I mean, most of the SPACs that, if not all the SPACs that ended up getting into trouble were because they had no business going public in the first place. They didn't have the amount of oversight they needed. A lot of them didn't understand what the regulatory requirements of being a public company really meant, and they had no business kind of doing it. But because people can make a certain amount of short-term cash on an initial offering, it's like, why not go spend? It's like, it's like, well, if we can churn some Bitcoin, look-alike, make a bunch of cash and get out really quickly, we're going to do that. And people can do that with SPACs too, because
Yeah, there
there's
was a FOMO with it.
you
There was
know
an urgency, like, hey, we got to return our money. Let's go buy. And it
totally.
wasn't. They're they're totally blinded on some of these companies they bought.
Well, and they're coming back now too, because there's such a there's such a logjam of IPOs and larger PE exits right now that everyone's starting to look at SPACs again and be like, maybe it wasn't as bad as we thought, and it was as bad as we thought, and they shouldn't do it, but they'll still do it anyway, and we'll see what happens. But
Kevin McGee, that was fascinating. And so, if anybody wants to do QSBS and needs an attorney to help do that, go get on Search Funder, but also he's on LinkedIn. Kevin McGee Law. Yeah. Thank you so much for your time.
yeah, thanks, man. This is fun.
Stop.